Hey everyone, John Henry here, slingshotfutures.com. Probability and risk versus reward. How to use these tools to ensure that you are trading correctly in the markets. So like we were talking about, probability versus risk reward. One thing that a lot of traders, and this is a very common thing that traders only look at one side of, but forget the other. Very rarely do you see them combining the two together. So probability by itself is good. We need to know what the probability of a trade is, but at the same time, what is the risk-reward association with that probability? Now, what I mean by that is, let's say as an example, you're trading a specific setup. It doesn't matter what the setup is. Maybe you take a 50% pullback every time it happens, and that's your trade setup, right? Well, very likely, a probability of something like that not going to be very high. Sometimes it works, sometimes it doesn't. So let's say worst case scenario, 40 to 50%, right? And because we're going worst case, let's just say 40% of the time it works, 60% of the time it doesn't. Right, so if your game plan every single time is to buy a 50% pullback and you know that you have a 40% likelihood of success, well, okay, we have part of the story. Now, if we're looking for the target placement, where should we go? Well, a lot of traders like doing one-to-one, right? So if they put their stop down here, they're going to place their target up here about one-to-one distance. But that's a little bit of a problem. Because mathematically speaking, if we were to zoom out and we were to take this trade every single time, and we use an example of 100 of these trades, well, 40% of the time you're right, and let's just say you make $100 here if you're right. So you make $100 if you're right, and if you're wrong, you lose $100. And you're only 40% accurate. The math doesn't add up. So we need to make sure that we're stacking probability along with the risk reward on the trade. A 40% trade can be a really good trade. I mean, heck, a 10% probability trade can be a really good trade, provided you are using the correct reward versus risk. Now, when we're looking at something like this, what do we need to know? If we're looking at a 40% probability of success on any given trade, we know automatically, right off the bat, we can't go for a one-to-one. Doesn't make any sense mathematically speaking. I know that if I were to go off 100 different trades, if I lose $100 60% of the time, that's negative 600. If I'm right 40% of the time, I make 400. That's negative 200, right? That's a losing strategy in the long run. So we need to make sure to flip those in our direction, in our favor, so that we are trading a favorable type of trade setup. So 40% setup like we have here, that's okay, but we have to adjust our approach a little bit, right? Instead of going for a risk reward of, a one-to-one, we know that we can't do that because if we're looking at 40% accuracy, we have to go more than one-to-one in order for this trade to be successful in the long run. Remember, over the last 3 times that you took the trade, it might have worked every single time. That doesn't mean in the long-term probability is still 100% accuracy. So we need to adjust for that long-term growth potential. We want to be around for a while, not just win 3 and then blow the account out. So what we're looking at then in this case is we need to make sure that the math falls in our favor. Generally speaking, with 40%, you want to be at around 1.5 or 2 to 1, meaning that if I'm risking $100, right? If I'm risking $100 here, my target needs to be between or at least $150, if not $200. Now, there is a way that you can kind of confirm whether or not this math is correct and which one you should be going with simply by just adding them up, right? If we take 40 times that we're correct and we make $150, does this total amount, is that greater than 600? Because we're losing 60% of the time, and when we lose 600. So that's where the math really starts coming in, and that handy-dandy little calculator application can give us a big heads up on what way to approach it. So $150 on a win times how many? 40 times, right? We're correct 40% of the time. That's $6,000, right? So $6,000. Okay, well, that's great, but wait a minute. 100 times 60, yeah, that's 6,000 too. So we know that in this type of situation, with a 40% accuracy, if we're going for a 1.5 to 1 reward versus risk and a probability of the trade at 40%, we're break even. And if you factor in commission, we're actually losing a little bit. So that means that on this type of scenario with a 40% accuracy, we need to be going for more than 1.5 to 1. Anything above that is icing on the cake, and you figure 1 or 2% difference for commission. So you need to be at least going for a 1.75 or more to be profitable, and generally without having to do a bunch of weird math, 2 to 1 is a lot easier. So when you're looking at a 40% profitable scenario and you are taking that trade every single time and you use the context of a lot of trades stacked up so you can get the probability really knocked down, then you're looking at needing to go for about a 2 to 1 in order to overcome the times that you're wrong, as well as overcome the commission costs of the trade. So it's always this balance game between risk reward and probability. Now, we can also flip that on its head and say, okay, well, what if I like scalping? Scalping generally means that you're going to be a lot more accurate, but there's always a trade-off. What are you trading off to be more accurate? Well, you're probably increasing your risk. To draw it up in simple terms, if our entry point is here and my target is that green line and our entry point is here and my risk is down here, the probability that I'm going to be right is going to be astronomical. We're floating 90-95% accuracy with something like this because it only has to go this little bit for me to be right versus all the way down here for me to be wrong. It's a little bit of a double-edged sword, though. You're going to be right a lot, but the times that you're wrong are going to sting a lot. And not a lot of traders can handle that. They love the times when they're doing good, but then that one loss that they take, it wipes out 6 or 7 different trades. That doesn't feel so great. So there is a little bit of a psychological aspect that has to be taken into account as well. But mathematically speaking, is this a likely scenario that works? Is this in our favor? So again, we'll use easy numbers here, but let's say as an example, my target is $100 here, right? That's my $100 target, but my risk is $1,000, right? I'm risking $1,000 to make $100. Well, out of 100 times, I'm going to be right 90% of the time, assuming that this is a 90% probable scenario. So, well, 90 times 100, that's 9,000, and 10 times 1,000 is 10,000. So 90% accuracy is not good enough for this risk reward. So you can start seeing how easily it is to kind of lose sight of that and say, okay, well, I know I'm 90% right, I'll just take it, no big deal. Well, it is, because mathematically speaking, in the long run, you're going to lose your account if you trade that way. You need to make sure that the probability is in your favor enough for this type of trade to make sense. Whether it's scalping, whether you're going for bigger targets, smaller targets, whatever your type of target is, you need to always ensure that that risk reward is in your favor. And again, the easiest way is just assume that, you know, after doing a little bit of back testing on your specific strategy and knowing that, well, this trade setup tends to be about 40 to 50% accurate. Perfect. Now you know the probability. What risk reward do you need to put on that trade to ensure that that probability doesn't change too much and that you're also making money at the end of that 100 trades or 1,000 trades or 1,000,000 trades? How much do you have to adjust when you're looking at the risk reward compared to the probability? Something that you always need to be taking into account, especially when you're doing a little bit of back testing and trying to figure out the best strategy. Now, a key thing that you need to not forget about is if you did a bunch of backtesting and you see that a pattern is generally about, let's say, 50% accurate. Well, that's great. 50% accurate, I can probably go for a 1.5 to 1 on my reward versus risk. But then you have to backtest again, and you have to say, okay, if I'm looking for a target of 1.5 to 1 on this trade setup, and my stop is here and my target's here, and I'm willing to make 1.5 times as much as I'm willing to lose, does my probability change at all? Right? Just because you know what the probability is right now, you may not have backtested the amount of probability when you're looking at the targets. Probability could just be, well, it bounced a tick, it went up, right? I mean, it did go higher. That doesn't count, right? So you need to backtest with these adjustments. And every time you make a change, you need to make sure that that still fits what you're looking for in your trading. So something to keep in mind, something to add to your tool belt, and definitely something that needs to be done in your trading if you have not done it already. Make sure you know the probability of a trade setup and make sure that your risk reward falls in alignment with that. And if you don't know what the probability of a trade setup is, let's say you're trading something discretionarily like price action, probabilities change from candle to candle. If you look at something and you don't know what the probability is, it's a big clue that you should probably be going for a bigger target. If you don't know what the probability is, if it isn't clear what you think is going to happen, or you don't feel like the probability is in your favor where you can say, yeah, it's probably going to work, you're probably looking at about 40%. You might want to consider going for a bigger target. So that's going to do it for this one. Hopefully you learned something, found it interesting, maybe something you can add to your tool belt. As always, if you have any questions about it, feel free to send me an email, jbrink@slingshotfutures.com. Till the next one, we'll see you all then.